Victor, I don't know if I sent a link to the last lecture we had on group accounts. Did I?
Yes, I received the link. I received the link, but I'm yet to go through the video. But I received it. Thank you.
Okay, so let's just do a bit of some storytelling on group accounts, just storytelling before we go into the other things that we're going to look at today.
All right, that's okay.
Group accounts is guided by an accounting standard coded IFRS10 as on consolidated accounts. The principle is very easy, Victor. The same relationship that us as children have to our parents, or as our children have to us as parents, that is the same relationship and the same concept.
All right.
So with the IFRS 10 on consolidated accounts, it works on an assumption of control. There should be some control. But how do they define this control? Mama is saving close. Close. These are problems. Okay. Thank you. So it works on the concept, on the assumption that there is control, but you have to determine this control. So when we look at control, there are only two things. Actually, I said three things. That is what I mentioned to look. That one, there should be financial and operational policies. So you should be able to direct financial and operational policies. So there's financial, there are operations and policies. Why? Because you as a parent company, so there will be two companies. There will be the parent company, that which has acquired, at least presumably, more than 50% or 50% and above, more than 50% shares.
Yes.
Then there will be a subsidiary company that has been acquired. It doesn't matter how many shares you have actually acquired, as long as it is more than 50% shares, you are in majority, and based on the shareholders agreement, you have been given the mandate to direct the financial and operating procedures of the company. Then would actually say that you have control. Just that you have control. But obviously, if you haven't bought all the 100% shares, whoever buys the remaining shares is regarded as a minority shareholder. And I went on to joke about it or around it with Luke. I said, unfortunately, even the human rights issues have actually entered or penetrated into the preparation of financial statements.
That's it.
Around 2007, around 2005, 2007, when I was actually, there was some course, some program called NATEC in Zambia.
Yes.
By then, I think I was the examiner, and also I had a school in Livingston called Hard Knocks Tuition Cafe. During that time, we never used to call these minority shareholders as minority shareholders. We went on, we used to call them as minority shareholders. But because of human rights issues, Today we are told we should not call them minority shareholders. Actually, we should call them the NCIs, which is the non-controlling interest. That is how bad it is as well. But I feel to be called non-controlling interest is even more insulting than if I was to be told that you have minority interest in this particular company. But we know, even when you look at the Zimbabwe issue there, you'll find that you have the Shonas, you have the Ndeleles, then you have the Tongas along the Kariba. So the Tongas are like us, the Ilas, the other side in Zambia, that we are only less than 2% of the population of this country. But maybe it might be so, it might be regarded as discrimination for anyone who believes that they're in the majority to call the Ilas or the Tonga speaking people in Zimbabwe as minority speaking tribe or whatever. So they should be called, from their own wisdom, they should be called the non-controlling interests. So that is basically on the concept. But then in terms of the preparation of these financial statements, we are actually saying that even if you do not have the major, you do not have shares more than 50%, as long as the other members, as long as the other shareholders, Victor, they have widely, the difference in terms of the shareholding is that it's very difficult to bring them together to have that majority voice. And you're the majority within those fragmented shareholdings or shareholders. You can still be given a mandate to guide the financial and operating policies of the company. Yeah. And at that time, you have the control. And as long as you have the control, you'll be mandated to consolidate the financial statements.
All right, all right.
There's one thing, again, you may not be allowed, which I never mentioned to look. You may be the majority shareholder, but as long as you're a minority to another company, or you're a subsidiary to another company, you will not be allowed to consolidate the financials. Because in short, it is not you who is actually directing the financial and operating activities of the company.
All right, all right.
But then, again, one thing that we have to appreciate in this is that these two companies, the subsidiary company and the holding company, like we mentioned last time we made look, is that they are independent companies. They are separate entities. So by law, they all come up or prepare their financial statements. But then you who is mandated to consolidate these financial statements as a parent company in this case, you need to adhere to certain rules. One of the things that you have to do is to remove anything that looks intra. Any intra dealing that has to be cancelled from your financials. To start with, we'll first what intra dealing is happening or happened. The first one that happened, it is at the point of acquisition. When you as a parent company acquired these shares from the subsidiary company, in your balance sheet or statement of financial position, as you call it, in the corporate world, we are still calling it balance sheet. In the statement of financial position, as you call it now, because human rights have all entered in all these things. In the books of the parent company will show that we have invested in Look Limited. And this is so much we have invested. So whether it is cash that they gave Look to get the shares, or there was actually a share exchange. option, but we have to show how much we have invested. So if it is cash that went into Luke's books, it will show on the first part of the balance sheet, Victor. It will show cash. But it should always balance with the last half of the balance sheet. The last half of the balance sheet is basically for funding purposes. The first half of the balance sheet is being funded by the last half of the balance sheet. I've always called it the eyes and the ears. Where you see assets, those are the eyes. You are able to see that this company has vehicles, has buildings, equipment, and all these other things, plant and equipment. Because we are able to see them, then it means that those are assets. They are eyes. But these assets, how were they built? There should be a justification of some kind. What built those assets? And those are the things now you have to look at down there, which is either equity or debt, which will come in form of current liabilities or non-current liabilities or both. That is the liabilities and the equity component. Actually, on the last half of the balance sheet, this is what actually brings a lot of rumor mongering. A lot of here in Zambia will say mulomo. Because if as things that we are able to see that Luke has or flouts, if we cannot explain them, or Luke cannot explain them, or has no, just keeps quiet, then we say, look, that hammer, that black hammer Luke drives in Havoroni. Do you know what he did? He was a Phineas. He went on and did the property grabbing. You remember Phineas in an area?
Yeah.
Oh, Luke has now gone into black magic, and we love it that much. And mostly the people who say this is our family members, unfortunately. You should not have anyone dying in your family if you have things. They will say, this is how he's getting these things. So in short, what they're actually saying is that that is not from his sweat. There's some liability somewhere, some black magic. Or they'll say, no, Luke has worked hard for these things. That is his money. He has been in banking for all these years. Then we know it's equity. Or no, recently Luke went to FNB Bank where he actually got a loan of 200 puller. So then we know that those assets that he has, those things we are able to see are actually being funded by liabilities. Then we say, don't even admire what Luke has. He has a lot of debt. In Congole, Chabe, in Zambia, this is what we say. So, we will need now to cancel, like I said, in the parent company to come in as an investment. In the subsidiary company, it will come in under equity there. It will increase the share capital. It may also increase the retained earnings. So we need to cancel those elements. From the subsidiary company, we cancel them. Equal amounts, we cancel up there in the holding company. Then we are able to consolidate line by line assets for the subsidiary, assets for the parent company. We add 100%, 100%. We come now under equity. Under equity, we are not going to touch it. We'll have to touch with caution. The share capital we are going to show under equity, please, is only that which is coming from the parent company at 100%. Why? Because what is on the other side of the subsidiary company has already been cancelled. Those were intra. You have already cancelled it with your investment in the parent company. I hope my storytelling is okay, Victor.
Yeah, it's a very, very okay.
I do a lot of storytelling. So
Yeah, I can understand it.
this is why they call me Coach Cat. I just explain these things and you go and write and pass exams. You always, when you're in the exam room, you just be hearing my voice. So then on the parent companies under equity, why you're only picking that? Again, it's just reasonable. Can you, for example, you are the parent, you have acquired, let's say, for example, you have acquired a wife.
Yes.
There's no way you can add the two. That is an acquisition. So under share capital, you only show for the parent company. If it's a child, the subsidiary, as we were saying, that is a child. You can't say now you have 3 parents. No, or you have 2 parents. This is why you're not adding the share capital from the subsidiary company. But the most important thing is that that share capital has already been cancelled with your investment in the parent company.
All right.
Then on the retained earnings, or going down, the share capital, the premium share capital and all that, you are only picking 100% from the parent company. Under retained earnings, the only thing you are going to combine with the subsidiary company, and understand this, is the post-acquired returns or profits, post-acquired profits. And again, it's simple. The pre-acquired, at the time the parent company was buying shares, was buying the company, the subsidiary company, did not go and buy shares like physically getting the shares. No, all they were buying, it was the net assets, which is how much is the assets? How much are encumbrances, which come in as in form of liabilities? Subtract that. So it's assets less liabilities, you get net assets. So all you are buying shares and the retained earnings. So any retained earnings that was earned at the point of acquisition, that will actually be part of your acquisition, and that is what you're canceling with your investment from your parent company and your retained earnings and equity and all those things from the subsidiary company. So meaning that the post-acquired retained earnings that you're going to pick would be the total retained earnings on the subsidiary's books minus at acquisition. Whatever you get, you multiply it by the shareholdings. That is what will go and sit there. So then the next thing you have to do, if you did not buy as a parent company, you did not buy all the available shares 100%, you do not buy 100% of the shares. It means that there's someone who bought those shares, who in this case is called the NCI, the non-controlling interest. So with the non-controlling interest, do not even get worried. All you do, you pick the retained earnings, regardless whether they were post-acquired or pre-acquired, you pick the total. So all you're doing, in short, you're getting the net assets, as is the net assets, times the NCI percentage. That is what you put down there as in non-controlling interest. I was telling Luke that there is a reason why the crafters of these standards decided that the NCI shall sit in between equity, the owners of the company, and the debt investors. Because there will always be two types of investors in this world. There will be those investors that are actually investing in equity, and those that are investing in debt.
Yes.
So the NCI, they are equity investors. Unfortunately, you do not have an interest, you as a parent company, in the shareholdings of the NCI. So you may regard them as outsiders, but again, you don't throw them under the bus. So you put them in between the external investors who are debt investors and yourself, so that they sit in between.
Okay.
Victor, does it make sense?
Yes, it's making sense. It's making sense.
So we'll be going now to Goodwill, and we'll do a bit of some computations, but let me just do the storytelling again on Goodwill.
All right.
If you as a parent company, bought 100% of the shares in the subsidiary company on what now turns out to be a subsidiary company, but the amount of money you have spent in the acquisition of those shares, if it is equal to the net assets of the subsidiary company, it means that you have actually bought this company at par value. Therefore, you cannot compute goodwill, because your investment, what you have put in there, is equal to the shareholdings or the net assets in this case.
Yes.
But there is also another scenario where they scam you. The people are selling that company, like for example, Twitter, being bought 9.2% of the shareholdings, being bought by Elon Musk. Then Elon Musk is actually scammed, where the investment or the money that he has spent in acquiring the maybe 50 or 70% of the net assets in this particular company, if he spends $3 billion, yet those shares he acquired at book value, they were 2.5 billion. In the books of Elon Musk, in trying to convince himself that what he did was correct, because he bought that company, acquired the shares at $500 million above the book value. So intelligently, Elon Musk, in trying to remove his shame, will justify why he bought those shares or the net assets at above the book value. And you confidently call it in English as goodwill. But when it's just basically stupidity. You go into this town just after Kasani. What is this town? Not NATO. What is that?
Which one? Kazungula? Not Kazungula.
No, just after
Not
Kasani, when
Kazungula.
you're going to Hauron, into Francistown. So at
Nata.
some point, yeah?
Should be Nata.
Yes, Nata. So you go and buy a house in Nata. This house, the book value of that house is 50,000 rands or Pula, for example. then the owner of the house convinces you to buy it at 55,000. Even when you yourself, you know that it's 50,000, you buy it at 55,000. Then you go and tell your friends, you go and tell Vic that, you know what, you start justifying why I bought that house at 5,000 above the book value. It's because it is near the road or the tarmac or the main road going into Zambia and Zimbabwe. So that when they are coming, when my relatives are coming from Vic Falls, at least I can say hi to them, even when they don't just come home. They will just tell me, no, when the bus will be by the station in so many minutes, I can just walk over and just say, hi. So this is why I bought that. So now you are actually justifying that there's some goodwill that you bought above that asset. You are also buying the goodwill. Then you go on to say, no, because it is near the hospital. No, because it is near the school. I don't need to drive taking my children to school. So it's near a school. So it becomes goodwill. But in short, it's just a scam. Victor, it doesn't make sense.
Yeah, it makes sense.
Okay, now I'm done with storytelling. Let's go back to the presentation. So I've explained what this goodwill is in a more comical and humorous way. I enjoy humor. Sorry, I'm just sending this. But are you able to see the presentation?
Yes.
Okay.
I can see it from my.
Okay, that's good. So we are saying on acquisition of subsidiary, the parent usually pay more for the subsidiary than the value of the net assets, which I've already explained, which is just a scam, and you have to justify that scam. But then the reason in the exam, don't write a scam, please. Write something different. In the exam room, don't write a scam. Just think about it that it's a scam and you're trying to justify why you have been scammed. And the justification would be one, maybe it's customer loyalty, good reputation, brand visibility. Like, for example, you're buying Coca-Cola. The value of Coca-Cola is above the actual net assets. Above the net assets of Coca-Cola. For a simple reason that there's some brand visibility in there. Customer loyalty, people already know Coca-Cola, so you don't need to waste time to start marketing it.
Yeah.
So good reputation. It may also be, you remember those 4 P's in marketing, isn't it?
Yeah.
Promotion, place, and all these other things, price.
Yeah.
So some components of the 4 P's, you can bring them here and put it as part of your goodwill reasons. So we are saying the difference between what the parent pays and what the net assets are through the weight is referred to as goodwill. So now you understand what this goodwill is. Because in your advanced financial reporting exam, they don't miss on group accounts, and you have to calculate goodwill. So now that you know about goodwill, now I can explain the formula of goodwill before we look at it. I can also do the storytelling. So the storytelling on goodwill computation. Remember that is to assume that you haven't bought 100% of the shares. So what you know for sure, you don't know how much the other players bought the shares, with the non-controlling interest, how much they bought the shares. You are in no better position to know that. But what you know is how much you bought those shares, isn't it?
Yes.
Yes.
So you're going to show in your goodwill computation, the first line, you will show the purchase price or fair value of consideration. So you show the consideration, which can be cash, shares, and whatever it is, the deal that you have struck. So you put how much you have spent. But then in calculating goodwill, we are not only looking at your how much was spent in there. Remember, there's net assets, which is actually a combination of your efforts and somebody's effort, whom in this case you're calling as an NCI. So it is fair that you put how much you have spent in acquiring those shares. So the second line will be for the third players or the third party, who in this case is the NCI. At acquisition, how much did they spend at acquisition? You don't know. So you're not going to look at the actual money they spent. You are going to use a fair way of determining how much can be included in there for you to calculate your goodwill. One is either you are going to look at the proportionate of the net assets. So meaning that if the net assets are, it's 100 Zimbabwean dollars, you are going to multiply that by the NCI rate, which could be say 15%, 20%, 30%, which you are going to include there. You are not going to show the actual amount that the NCI paid, because that would be a big task for whoever is preparing the financial statements, because doesn't know the deal that was actually made by those third parties. But the only thing you can do is to come up with a fair professional judgment using the net assets and getting a portion of the NCI. Victor, I hope you're getting the theory behind these things.
Yeah, yes, I'm getting it.
That would be method one, look.
Yes.
The second method would be where the examiner tells you, or you know, you as a preparer of the financial statements, you know that the fair value, have been told the fair value of this particular asset, net assets, the fair value of the net assets is 102. So even when in the balance sheet you are able to see the net assets, you are able to compute the net assets. Ignore what is actually sitting in the balance sheet, because indirectly you are being told that use the fair value and not the proportionate of the net assets. So once you get that amount for the NCI at acquisition, you also get how much you spent in acquiring these shares. So it shows the total amount that both parties could have spent, may have spent. Not they spent, but they may have spent, at least you know on your part. But you don't know on the third party. But you are able to determine how much you spent the value. So you will show how much it costed both parties, less the net assets at acquisition for the subsidiary. So what you are going to get will be basically goodwill. That is to assume that the value at which you are buying is higher than the rest. If you find that there's a loss, do not apportion that loss or put it as negative goodwill. There's nothing like that. You have to immediately recognize it as an expense. Are you getting me?
Yes.
It has to be immediately recognized as a loss. You do not share losses. You can share profits. Losses have to be recognized immediately, and you start mourning and bury them later on.
All right.
Mm-hmm. Okay, now that I've explained, I'll give you about 5 minutes to compute goodwill, then we'll do it together. To compute goodwill using the first method of proportionate share of net assets, then you use the fair value method. Do not fear in making mistakes. Victor,
Alright.
if there's only one place you can do is at Coach Carter's Academy, where you can make as many errors as possible, but do not allow yourself to go and make errors in the exam room. So let's make these errors. Let's discuss about them. I believe in when I'm training people, I always want to make them appreciate two concepts of learning. There's what we call memory mapping, mind mapping, which you'll be seeing me doing as we move on, the way I remember things and the way I put them, the way I place them up, and memory pegging. So memory pegging, I'll be using examples of the Cerese Karma with the way is the problems and the fights is having with the current president. I'll be using the Chamisa, the other side with our crocodile. I'll be using the Hitra who was there. Maybe Victor didn't even know Hitra in Zimbabwe, the war veteran. I'll be using the examples here in Zambia of the Kaundas, the Satas, the HH, the Lungus, the Kalushawadia that you know. I'll be using the examples of Grobler and all that. It's for a simple reason, and I'll be using them in a more humorous way so that you're able to memory peg. As you go into the exam, you will think about these jokes and you will know where they apply and how you can convert them into something that the marker is going to mark you nicely. It's called memory pegging. Mind mapping is where you map, you have, for example, if I say goodwill, what are the reasons on goodwill? So I know the first thing that comes in is memory pegging, that I'm thinking of scamming. So I think of one scammer in Zimbabwe that is known, or in Botswana, then you laugh while you're in the exam. Then you know, okay, this is what it means. It means that for goodwill to happen, it does mean really that you have bought the shares or the company at a higher price than its book value. So I've been scammed. But what are the reasons that I will justify? Then you bring in customer loyalty, you bring in the brand visibility.
All right.
Mm-hmm.
All right.
So please do this. Don't fear to make errors. I'll give you about 5 minutes, then we can continue later on.
All right.
Okay, thank you.
And be free to cross-pollinate ideas amongst yourselves.
All right.
All right.
Together. Mm-hmm. So the first method, Victor, or the one we have the fair value consideration. Oh, let me use a proper. So the fair value consideration . This is basically what the parent company spent. So it says a parent company buys 5% of the equity shares in subsidiary company for 156,000. So they buy for 156,000.
Yeah.
And this one is not speculation because it is the parent company that bought. So they have the information, isn't it?
Yeah. Yeah.
So now we go to the NCI. At acquisition. Because we are using the first one, which is the proportionate share of net assets. So what were the net assets? So we know that the net assets is 170. So meaning to be 170 times 25%.
The NCI proportionate.
Yes. And I gave a reason why you are picking this, because you don't know how much the NCI bought the shares. So the only thing you can do, you can only look at the proportionate.
Yeah. 42,500.
How much?
42,500.
500.
42,500.
Yes.
Which gives us how much?
113,500.
1, 1. It's not
127. 127,500.
So I calculated wrong.
156,000 plus 52,500. How much is it?
156,500 plus 56.
Yeah, adding.
Because it's 156,000 plus 42,500.
42,500. It's 198,500.
198, yes.
Oh, we were subtracting.
No, because we are adding. So you're adding what the parent company spent and what you think the NCI could have spent using the net assets proportionate.
Proportionate, okay, yeah. All right.
So you're not subtracting, you're adding. So which is 198, 500, right?
Yes.
I'm just trying to get the...
Coach Kat. Okay, I think let me let you finish. And I'll ask.
Okay. I can see my pen. Okay, I found it. Then now, let's net assets. So the net assets at acquisition, it was how much? It was 170,000.
70,000.
So I'll do this maybe just to show that you're subtracting. So what will be the goodwill? So you're saying this is so much that was spent, 198,500 from the parent company and the NCI.
Okay.
When the value of the company at acquisition was 170,000. What's the difference?
28,500.
28,500.
So goodwill. Is it 28? Is it 28,500?
Yes, 28,500.
Yes, 28,500.
28,500. That is for method 1. You had a question. Is it local, Victor?
Yeah, I had done it another way. I'll get 28,500, but I think maybe I will not get marks for working.
How did you do it?
What I done is that I calculated the NCI, right? Which is for that 25% of 170. And then I took the 170 and I said the less the 25%. Then I get 127, 500. And then I said, since the portion that I bought is valued at 127, 500, and I paid 156. So the difference between the two, then it also gives me 28,500.
Theoretically, I think you should get the marks. You should be marked well, because what you have just done, you have looked at the net assets, and you are saying with these net assets, if 25 is going to the NCI, meaning that 75%, 75% will be for the parent company, isn't it? Which you got how much?
Yeah. I got 127, 500.
127,500. So all you are saying is that this 127,500, how much did you pay for it?
Yes. Then I paid 156.
156. So it gives you that same thing, because on the NCI, you're assuming that the NCI, you haven't apportioned any goodwill for them. That's what you have done.
That's what they are.
Which is very unfair. But for any marker who understands financial reporting or the concept, can still give you a mark. But I don't think you'll give you full marks. Because then you're assuming that goodwill is just, you have taken it, if at all you are trying to do to apportion that goodwill, that the whole 28,500 is attributable to the parent company.
Okay.
Which they bought, which they paid. But in this case, we're actually socializing that goodwill, the 28,500, meaning that I can get 75%, which I'll say from this,
and then
500, 78% may actually come from the other guys. They paid because here now what you're saying that it's not just you alone who fully paid the wrong or the scammed. You are assuming that you are all scammed, you and the NCI. But unfortunately, you're still right, look. Because as long as the NCI is getting a percentage, now you're still right. As long as the NCI is getting a percentage from the net assets in the balance sheet, meaning that the NCI, there is no component of goodwill from it.
Yeah, because I assume they've already taken it in their 42,500.
And not just that, understand this. The NCI by principle is different from the fair value. If you're using the fair value concept, you'll be different. But as long as it's a proportionate share of net assets, the NCI, they are getting directly from, because this 170 is coming from the balance sheet, isn't it?
Yes.
So if they're getting a component of the net assets there, meaning that from your computations, it will still be zero goodwill. So you are still right by picking this component here and picking the component attributable to the parent companies. So while you're saying that if it was normal, this 170, I'll multiply by 75%. This is so much that we should have paid, but we paid 156. And the difference is goodwill. I think you're still okay. If it was in court, you still argue that, and the judge will see merit. See merit in your argument. Because these things, like I've always said, it's just logic. And you see from which topic, with any topic that we look at, we will not look at a topic that there's no logic in it. You don't need to read these things too much. Just understand the concept, Victor.
Okay.
The second method is even easy. Because the second method, it says, you will still pick this 156. Here on the 42,500, you are not going to pick that because I think the remaining shares were valued at 52. So this will be basically for the NCI. So meaning that you are going to have, instead of having this 50 whatever, let me do this, sorry. So here you're actually going to have the 52,000. This is method 2. So which gives you how much?
208,000.
208, yeah.
28. Which takes you to, is it 38?
Yeah, 38, yes.
So the goodwill in this case will be 38,000. What? Any questions on goodwill?
Nah, nothing on my side so far.
So far, so good.
Okay, the storytelling is okay.
It's okay.
Yeah, it's okay. It's making it easy for us to understand.
Yeah. Okay, let me just say what is. Okay, so on the first of the balance sheet, there may also be a component on the revaluation. So you don't just expect that you are going to have share capital, retained earnings, maybe share premium. You may also have the reserves, revaluation. So as long as you're revaluing your assets, they will create an account there because, like I said, as long as there's no cash involved, or it is not receivables, meaning that the first part of the balance sheet must balance with the last part of the balance sheet. So if, for example, you say you revalued your property from 50,000 polar to 52,000 polar, for that thing to balance, the 2,000 polar will come in under other comprehensive income in the income statement, which will add to your net profit. And you have a value that goes directly into your retained earnings. But before it goes in there, in your source, you remember the source, statement of changes in equity. There will be movements from your retained earnings into, you are going to debit your retained earnings and credit your revaluation reserve. Do not forget these things. They are under IS1, preparation of financial statements.
Yeah.
So you are going to first, we are saying that if, and you will find such questions under this particular topic, that they revalued the assets or the property, and the property was valued upwards by 2,000 pula or 2,000 kwacha. So meaning that your assets or non-current assets, they would have increased by 2,000, therefore increasing your assets by 2,000 kwacha or pula. So now that your first part of the balance sheet has increased by 2,000 kwacha, you should think, how is this balance sheet going to balance? One, because it's a revaluation, it's not, there is no cash or transaction, it's not, it does not involve receivables. It does not involve cash. that maybe there'll be reduction in cash. No, it's a revaluation. So what does it do in your income statement? On a section called other comprehensive income, there will be an increase in the fair value of 2,000, which you are going to add to your net income and get what you are calling as whatever you're going to get down there as total income, whatever it is, from your CI, your comprehensive income. So once you get that amount goes into the balance sheet. But before it goes into the balance sheet, it has to be split. Look. So you have a schedule called the Statement of Changes in Equity, which is SOSIE, S-O-S-I-E. You want to see the changes in equity, what is happening there. So in that SOSIE, there will be equity or share capital, share premium, retained earnings, revaluation. Even dividends, that's where they will sit. So to come in as retained earnings, under retained earnings or retained earnings account, then you are going to debit retained earnings and credit the revaluation account. But from the balance sheet side, when you're doing a consolidation, you will not see that mechanics, but this is how these numbers flow. So all you're going to do is have 100% of the revaluation from the parent company and calculate a percentage of your post-acquisition reserve. Which you're going to sum and get a total number. That's a figure you're going to show under other reserves. Is it okay?
Yeah.
Yes, it's okay.
So I'll take you through the 5-stage workings. These are we'll have to use this mechanical way of doing our computations, and I'll be just explaining. So that those 2 questions that I've given you, we next time, and I suggest that sometimes you should be meeting frequently. Friday, if you have no issues, we can still meet on Friday, but we'll discuss that.
Okay.
That's okay.
So the first working that you'll be doing, and you work in that mechanical way, you will start with your group structure. You go to the net assets. You go to the NCI. You go to the group retained earnings. If you can work in that systematic way, it becomes easier. But I'll be explaining every stage. So the first thing that you do whenever you're given a question under group accounts is to check on the shareholding. So get to know what is for the NCI and what is going to the parent company. Then there may, in that question, there might be a component that is going to the associates or joint ventures, where you have shares maybe less than, above 20%, but less than 50%. That is to the associates, actually under the associates. And even the way you account it, it becomes equity method. But all it is, all you're going to do, you are going to be guided by a principle of significant influence. You do not have control, but you have influence at least. So second working will be on the net assets of subsidiary. These 3 columns. First, what you do not memorize the descriptions here. Sorry. Do not memorize these things. Just copy and paste. and equity and capital. So on this one, look, behave as if you're just a parrot. Copy what is under equity and capital. That is a representation of net assets.
Okay.
Because if you have the total assets, less your liabilities, it gives you this particular part. You remember your accounting. Is it the accounting equation or business equation?
Yeah.
Mm-hmm. So pick those in the exam. So remember, timelines are very important. There can only be 3 timelines here. The 3 timelines are, this one is number 1. When did you acquire? At acquisition. So you freeze everything at acquisition. Because those that will come under at acquisition, they will be candidates for your goodwill computation. At acquisition, this is what is being acquired, in short, by the parent and the NCI. By the parent and the NCI, they are acquiring this part. So on equity share, you will show at report date. So whatever is at report date is the same that you're going to show at acquisition. The share capital. The shares, I mean the shares. I've never seen a question that changes those shares. So what you see at report date, those are the same ones that you're going to say. If there will be a question that will have different numbers, then you pick at acquisition here. So meaning that when you subtract these things here, there will be nothing. Similarly, on the share premium at acquisition, which then you paste and at acquisition at the reporting date. Reporting date, you are seeing, 31st December as the latest balance sheet. It is at reporting date. But there were certain numbers that came in at acquisition. So you show those numbers. You subtract, there will be nothing there. You may have things on the revaluation reserve, which we'll be looking at some point, but retained earnings. So retained earnings, remember that you have at acquisition. When you as a parent company, you did not have the privilege to control the financial and operating policies of the company. So at acquisition, all these things were acquired and that you paid money to get all these things here, which is basically the net assets, which is your assets less liabilities, which can be fully seen from this particular component of your balance sheet. Then, in here, the difference between your retained earnings at report date and the retained earnings at acquisition gives you post-acquisition. So the numbers that will come here, these are the numbers that you're actually going to take where in your computation of group retained earnings in your computation, which is working 5. So they will go and sit in working 5, this in working 5. Here they will sit in your workings under at acquisition in working 3, which is on goodwill, and in working 4, which is on NCI. So under NCI, you have the computations that you're going to get from here at acquisition, but you're also going to get from the post-acquisition, also there will be working for here component. So whatever you have at post-acquisition, you multiply by the shareholdings of the NCI, and you add to what you're getting here, and you have the total NCI. So that is how it works.
Okay.
All right.
Mm-hmm. So on Goodwill, I've already explained on the computations. I did actually mention to you that on the fair value of net assets at acquisition, you pick it from working 2, which is basically from here, even from the balance sheet. So if you are able to see it, which is basically from here, this number there, that is what you pick, which is from, which I said is working 2. So you are now familiar with this, which is the fair value of consideration, which we have looked at. It can be shares, it can be cash, it can be a combination of it. From the parent company, this is basically from the parent company. Then from the NCI, you have the total, because this is what you call full Goodwill method. Then down there, that is where now you have your net assets and you can compute your Goodwill at acquisition. So for the non-controlling interest, which is actually working 34, like I mentioned, it will be basically your NCI coming from at acquisition, which would be definitely, you can pick from working 3, or from working 2, because this thing here, the net asset at acquisition, is coming from working 2. So it comes from working 2, it comes in here, then it fits into working 4, which is this amount, which is this line here. I know next time we meet, how I can even suggest on Thursday, you can also meet if you have enjoyed the class. then we have the NCI at post-acquisition. We'll have the amount there and we'll get the total for the non-controlling interest. Then we go to the group retained earnings, which obviously for the, you pick, like I did actually mention the other side, 100% from the parent company, and you only pick the post-acquisition for the subsidiary company, which you put in there, and we'll do the computations. Then you have other adjustments, but we'll stop here. So I sent 2 questions. You can try them, but I don't know when we can meet so that we look at those questions using this particular methodical way of computing, of preparing the group accounts.
I think Thursday that you have, I don't know, look, Thursday that you have suggested, it's okay on me.
Yeah, I think it's okay. Yeah, it's okay for me Thursday as well. What time is okay with you, Victor?
Yeah, 6. I like the time we started, 6 o'clock. It's okay.
All right, that's fine.
Actually, we can start at 6 o'clock. Yeah.
Yeah, 6. It's okay. I heard you talking of Charles. Is Charles joining?
Yeah, Charles was supposed to join us today, so I'll just let him know that we've got a lesson on Thursday.
All right, that's okay. I think 6 o'clock, it's okay.
Yeah, so on Thursday, we can have a 1 hour from maybe 18 to 19. Then on the Friday, because it's Easter, you can tell me what time. For me, if you are not going anywhere outside for Victor, I don't know if you're in Harare or Bulawayo or Guero. Yeah, so if you're not going to Guero, to Mtare, or to the village, and the local is not living Haboron, then we can. I'm not going to the village. I wanted to go to the ranch, but I'm not going there. I don't have the money. So we can still have it in the morning, maybe from 10 to about 12 or 11:30. Then Saturday, Sunday again. So I don't know. Friday how, or maybe I'm going to be clear on the program on Friday. When
I think we can
after the
talk
class.
on when we actually are having another lecture on Thursday, and then we discuss on the other lectures.
Okay, not a problem.
Yeah. Yeah, but I think if you are there, we can just meet. There's no problem.
Mhm.
But meanwhile, I think we'll go through those questions. But it was interesting.
It was interesting, right?
Explaining it for me, it was very interesting, because when you know these things and you've forgotten, and you bringing in the stories, yeah, it's coming in nice.
Mhm.
Yeah.
Look, what's the feedback of today's class?
I think, like Victor has said, I think it makes me pick the basics, obviously from logic, and then also get the basics, like the way I treated that question. But you coming with those stories make it easier for me to grasp the basics and the principles, actually.